And our next guest has been crunching those numbers. Alec Young is Chief Investment Strategist at MapSignals. He joins us now. Alec, nice to have you with us. Okay, so what happens historically when we're kind of feeling jittery? You go out 6 months, a year later.
Sure. Well, I think the key takeaway from our analysis at MapSignals is that you don't want to overreact to these spooky geopolitical headlines. We see a big dichotomy between what the market does in the first week and the first month after a geopolitical flare-up, like the current tension between Israel and Iran. The markets are generally down about 1.5% a week later, and that's consistent. The first attack was last Friday over the weekend, and this week the S&P is down about 2%. And if you go out a month, it stays down about 1 to 2%. But once you get out to 3 months, the market's up over 1%, the S&P. This is since 1940, and we looked at 29 major geopolitical crises. When you go out 6 months from the geopolitical event, the S&P is up 5.8%. And when you go out a year, it's up a very healthy 12.1%, which is above what the market actually gains in a typical 12-month period, which is a little under 10. So the message from the data is pretty clear. Try to stay calm. We know that the headlines can be curveballs. They're very unpredictable by definition. They can be scary, but the data clearly shows that whether it's a political coup, a war, a terrorist attack, a pandemic, markets price it in fairly quickly, and the initial negativity gives way to strong performance over 3, 6, and 12-month periods.
Alec, what about when you layer in other considerations? Probably the biggest one being, outside of everybody digesting the latest earnings, is reassessing what happens with interest rates. And we have seen the S&P 500 pull back from its all-time highs right now. What's your broader sense of what's going on? Because it hasn't really felt like investors want to wholesale exit the equity markets, but they have definitely hit the pause button recently.
Sure. Yeah, we're down as of last night 5% on the S&P 500 from the high a few weeks ago at 5265. So we're right above 5,000 on the index. As far as the interest rate situation goes and the Fed uncertainty about when they'll start cutting, the key is inflation. We'll get the next PCE inflation report, the Fed's favorite, on the 26th next week. As long as we continue to see a downward trend in inflation, which we think we will over the intermediate term, Fed cuts will take care of themselves. Interest rates will take care of themselves. The market's already priced in a little bit of a slowdown in disinflation. So some stickiness in the data. Inflation peaked at 9%. It went to 3. Now we popped up to 3.5-ish. So the market's already well telegraphed that inflation's a little sticky. The Fed isn't going to cut anytime soon. So if the numbers on PCE come in better than expected, we'll see a major rally and a reversal in the market psychology and the narrative to something much more bullish. And if the numbers come in a little sticky, that's already really priced in. So I think when it comes to the Fed and rates, unless you think that inflation is going to do a 2022 all over again and skyrocket, there's really nothing to worry about. What matters is the long-term trend, and that trend is clearly down for U.S. inflation.
Now, how do you take all of that and put together a strategy based around different industry groups? Because, when investors have shown a willingness to buy, some days they're very interested in tech. Some days they're very interested in, a broader global growth story that feeds into some of the commodity stocks, some of the industrial stocks. Everybody's got an opinion on the banks. People definitely get jittery on some of the rate-sensitive names. So there's a lot of considerations under the headline of where the broader market goes. How do you put it all together?
Well, at MapSignals, we're known for following the data. We track institutional money flows, and we come up with the sector rankings for the S&P and other indices based on those institutional flows. And what we're seeing is people really focusing on the reflation trade. So the reason rates are going up, the reason inflation's a little sticky, the reason the Fed's going to cut later than expected is because the U.S. economy continues to exceed expectations, and even the global economy is showing relative resilience compared to pretty low expectations in places like Europe and China. We're seeing areas like industrials, energy, materials, financials. These are the leadership areas. These are what the pros are buying on weakness. So we would recommend using this geopolitical and interest rate volatility as a chance to buy those reflationary groups. That's where the earnings visibility is the strongest. And then also we can't forget about tech. Tech is right behind the reflation trade in terms of what the big boys are buying. Most of the profit growth in the U.S. comes from these big tech companies. They represent a huge amount of the major indices. They've come in a little bit. We got Netflix yesterday. Profit taking after a tremendous run. We'll get Microsoft next week and the rest of the companies reporting in the next couple of weeks. So to the extent that we see additional tech volatility, more around selling the news after big run-ups into these earnings reports, we would be buyers there as well. So kind of a barbell sector-wise, focus on high-quality growth companies, tech, discretionary, but then also the commodity, economically sensitive reflation trade sectors like industrials, materials, energy, and financials.